Good morning, everyone. My name's Derek Goring. I'm Vice President of Development at First Gulf and the Chair of ULI Toronto. Thank you. On behalf of the Management Committee and the Advisory Board, it's my pleasure to welcome you here to the 2017 ULI PwC Annual Transit and Real Estate Program. Thank you for coming. Over 600 people registered for this event, which is a testament to the quality of the content and the panel we brought forward today, and is one of our signature programs. Our annual trends report is more than a set of data points. It represents a very broad cross-section of nuanced analysis informed by surveys of over 100 of Canada's leading real estate practitioners conducted by PwC Canada. It's an honor for us to work with PwC to present what has become one of the most invaluable insight tools in our industry. It's also a great privilege to present this expert panel who will provide an objective lens on the immediate future of what's happening in Canada and across North America. They will be introduced after the PwC report presentation. I also want to thank our event sponsor, Quadrangle Architects, as well as our 24 table sponsors. We would not be able to present this event without your support. Thank you to our sponsors. I'm now pleased to call on PwC's global real estate leader, Craig Hughes, to start our 2017 program. Craig?
Good morning, everyone, and thank you for inviting me along to do some brief opening remarks. Canada clearly punches way above its weight on the global real estate scene, but also looking at this, it's incredible actually for an emerging trends launch. We've had events in LA recently and in Amsterdam for the European and the US reports, but this really, really is fantastic. So thank you all for coming along. It's the 39th year of emerging trends in real estate, and wherever I go around the world, whoever I talk to, investors, operators, etc., they find it as great research and great insight. They think it's generated by the industry for the industry and looks forward really well. My role is to go around meeting clients over the world. We have about 5,000 people in PwC serving real estate clients. We're talking to, as I said, investors, developers, operators. And what I'm going to try and do here is talk about what we see there, because Andy Warren later on is going to go through the Canadian report for you in a bit more detail. So let's think about what are we seeing at the moment. And it won't be a surprise, but wherever I go, there is a continued flood of capital. If you look at the latest research we've done around the asset and wealth management industry, the capital for real assets, real estate and infrastructure, is going to grow from $1.8 trillion to $5.4 trillion by 2025. That is an enormous growth in capital. One client in Tokyo recently sat down, new allocation of $20 billion to global real estate. One organization, $20 billion. So that capital is continuing to come in. But there's a huge issue in terms of sourcing opportunities and deploying that capital. Wherever you go, people think in absolute terms that pricing is at pretty much all-time high, even if it's attractive from a relative basis to fixed income. And some people say most assets are priced to perfection. So how can you actually source and find the opportunities and deploy that capital? That organization I talked about has got $20 billion to deploy. It has 14 people to do that. 14 people to deploy $20 billion of capital in a global strategy. So they need to find real estate organizations. What does that tell you? If you look at it, people are worried about where we are in the cycle. Are we in the cycle? Are we past the end of the cycle? And that's consistent in pretty much every market I go to, but they can't see what is going to cause that cycle to change because there's less debt around at the moment, so it's not going to be a debt-fueled cycle, and that there's that weight of capital coming through. So what's going to trigger it? We've already had Brexit. We've already had some elections around the world with some worrying or surprising results, and that hasn't led to the correction as yet. So what could cause it? A lot of markets I go to, one thing that people are worried about is there's a huge demand for residential stock. There's a lot of supply coming on in residential, but they're mismatched. The demand is for stock at a certain level, and the product that's coming on is at a much higher level, and that product is in mixed-use schemes. So what will happen to those? Will they be ghost towns when there's nobody actually occupying that residential, and could that cause an issue in terms of occupation? So sourcing deployment, you're also seeing, with that amount of capital, you're seeing a bit of schizophrenia. The same organization looks at where we are in the cycle, looks at the great investments it made a few years ago, and wants to take some risk off the table and some profit off the table. At exactly the same time, they're being handed more capital to go and invest. So you're buying with one hand and you're selling with the other hand. So how do you rethink, how do you balance that, how do you justify that in the market the way it is at the moment? When you look at the reports that come out around the rest of the world, technology is changing absolutely everything that we do. And despite those changes and people being able to work from wherever they want, we see a lot more drive for urbanization and densification. So even though you can work from home, you want to work and you want to collaborate and you want to spend time with people. So that combined with new technology, combined with disrupted business models, is leading to a lot more demand for flexible space, for shorter term space, for co-working space. So that's another trend that's coming through. So I only had a few minutes, so I'm basically going to introduce Andy. Andy leads on research for PwC and has been authoring the report for the last 4 years. He's a great addition to the team, and he's going to run us through the detail of the report. But I'd just like to say that it's fantastic to have been here. I think Canada punches its weight on the global scene, obviously on the domestic scene as well. And if anyone wants to come and talk about Brexit or any of those other exciting topics, then please come and see me later on, and I'll hand over to Andy.
Thanks, Craig. Not like a lot of pressure. You come up after the global head who gives you all that insight on kind of what's going on. So we'll try and make the kind of the local picture just as exciting. And it really kind of is. You know, this was an interesting year in terms of interviewees and the survey responses. You know, things are similar to the way they were last year, maybe the year before, but there are subtle changes, the way people are approaching the markets. And I think it's kind of in those changes that we'll probably see some things that'll probably take place in 2018 that'll probably be influential on how the markets perform in the next few years. And so, you know, kind of rebalance, rethink, and reinvent are kind of the main themes that kind of run through, you know, this year's emerging trends, and particularly the Canadian perspective. You know, once again, you know, this is the 39th year of the overall emerging trends. We're starting our second decade of the Canadian version, so we're in year 11. The one thing I'd like to touch on is this year, our participation was as high as it's ever been. You know, and in this day and age where we're all bombarded with surveys constantly, you can't get off an airplane or leave a hotel room without getting a survey. We really appreciate you taking the time to kind of participate in that, not only through the interviews, but also the online surveys. So this year in Canada, we had over 110 interviews, touching over 95 individual organizations, so we feel like we have a broad spectrum of all participants. And then we had 325 online surveys responded to. So thanks again, and look for your survey next summer. Market sentiment. We always kind of like to start with, what are people thinking about when they're, you know, for 2018? How do they think it's going to be compared to 2017? And this year, for the second time, we kind of asked this question. If we had more time, I'd make somebody come up here and then we would play kind of one of those games where you get a prize if you can guess the first word. But the first one, number 5, was growing, which I think in 2017, that was kind of in the top 5, but probably it went up a little bit this year. And the growing part isn't that the market's necessarily getting bigger and there's more opportunities. It really kind of reflects people are looking for different opportunities. They're kind of expanding their horizon about where they want to invest, be it market, property type, participation level. Number 4 is uncertain. You know, I think last year when I was here, you know, for North America, we were all waiting to see how the U.S. presidential election was going to come up. So the survey was done in June. Uncertainty wasn't that high. You know, from the period of November through about now, uncertainty kind of has risen a little bit. But the market has gotten comfortable with this level of uncertainty. They're still going ahead. They're not paralyzed by going, okay, is there going to be tax reform in the U.S., which now we have a bill to kind of look at? Is there going to be health care reform? They're going, okay, we can continue to move ahead. We know this may happen, but I'm also making contingency plans for if it doesn't. Measured, kind of speaks to the point where we're in a long upward cycle. We haven't had a boom bust, so I'm just going to kind of keep looking at where my opportunities are in the next 2 or 3 years. I'm going to protect my downside, but I'm also going to continue to look to keep moving forward. Cautious, certainly makes sense when you're looking at a market like this where pricing has gotten high. People are aware of that, but they're not panicking about it. They still think the opportunities are there. But, you've always kind of got that eye in the rearview mirror, making sure nothing sneaks up on you. Then finally, any guesses on what the number one word is for this year? Anybody read the report last year? You can make them out. It's the same word. It's competitive. And once again, far and away, the number one word that people chose to describe the market. And it makes sense. It's a very competitive market, and the low-hanging fruit is gone. You have to work for everything, and people see that. But, it's become business as usual now, so people are comfortable with it. So what's the profitability for your business? 2017 last year was very good. Most of the responses are good to excellent. So that looks good. Did it change in 2018? Not really. In fact, actually, the excellent selection went up by 2%. So some people are thinking that 2018 is actually going to be better than 2017 was. So I think that positive outlook is still there. That doesn't seem to give any indication that we're looking at a downturn coming on. So the market looks stable, looks able to perform at that level. Now, this was Canadian responses. What about the U.S. responses? We're down to about, we saw the good to excellent come down just a little bit and a little bit of an uptick in fair. So then we kind of looked at the breakout of good to excellent. And you saw excellent kind of go up or go down a little bit, but good went up. And that kind of fits with the, the interviewee sentiment that we got. People feel like we're in a longer cycle, we're kind of at the top, it's going to continue, but I can't continue to get better and better every year at the same rate that I was, so they're kind of settling in to maybe a little lower expectation for profitability going forward. Makes sense, you look at 2014 when excellent topped, that was kind of the point where you had all the advantages of picking things up off the bottom. That kind of ended there, so we kind of move into this. Now we're in more of a stable market. The trends for 2018. I mentioned kind of themes running through there, rebalancing portfolios. How do you position yourself going forward? Reinventing real estate through technology. How is that going to play? Craig mentioned it's impacting the world. It's impacting how we do business. It's impacting how our tenants are doing business, and it's all kind of tying together. Affordability, that issue on housing affordability never goes away. It's still there. We're still talking about it. That's a U.S. and a Canadian perspective, kind of influencing both markets. And then kind of creating new opportunities through placemaking, excellent transit decisions that will help. And then kind of, will we see a rise in 18-hour cities, which Emerging Trends have been talking about the last few years in Canadian markets. And then, of course, the global war for talent. It's getting to be a very competitive market to find quality workers. And it's just something that I think all of North America is going to be dealing with in the next few years. Compare this to this kind of the U.S. We had kind of economic and demographic themes kind of coming together. As we looked at the trends for the U.S., we'd start down one road and we'd kind of touch, and then we'd start down another road and we'd touch. So we kind of saw these all kind of coming together. And for the first time in the 5 years that I've been doing this, everything kind of pushed to the markets. So we kind of saw this long cycle, increase in productivity, different generations coming together. So it all kind of pushed together. And there's similar themes, I think, between both Canada and the U.S. that kind of put us in this position. Rebalancing portfolios. The markets are tight. A lot of the property has been traded. It's in hands that want to hold it. So what do you kind of do in a market like this? You kind of look for opportunities. Do you build? Class A property to kind of put into your portfolio? Or do you go out and look for something new? Is this the time when prices are up to take advantage of selling properties that you'd kind of like to get rid of, and then can you redeploy that capital? So in the survey, we kind of asked, what would you want to buy? And obviously, fulfillment warehouse kind of came out as the top buy recommendation, from survey respondents. Age-restricted housing, which kind of touches on kind of the generational shift as the baby boomers get older and decide what they're going to do as they near retirement. Moderate income apartments touches on the housing affordability issue. And then medical office is a category that just continues to be popular as people look for more ways to put healthcare in the hands of people at a little more convenient center. What do we want to sell? This is kind of an interesting one, is retail. And that kind of ties in a little bit to the buy fulfillment centers. Kind of the rise in e-commerce is kind of shifting how we buy. And it's also a technology story, and it's also kind of a retail in terms of, department stores are shifting the way that they sell goods. They're seeing more competition. So retail kind of got beaten up in this year's survey. There's no way around it. If there's anything that's a little bit of a surprise out of that sell list, it's outlet centers, which, in previous years had been pretty high on the buy recommendation and still kind of fit that experiential retail mode. So maybe just kind of got sucked into the downdraft from all of retail. So where would we do this if we were going to buy? We just took the top 3 markets from each of these recommendations and kind of added Toronto in there so that you can see for a comparison if it wasn't in the top. And obviously industrial, Toronto, Vancouver, Calgary, kind of the top markets that people want to be in. Makes sense. That's where the population centers are, the greatest amount of economic activity. Calgary's kind of a distribution center, a lot of space there. Multifamily, you buy in Ottawa, Halifax came up high, Montreal. Office, kind of an interesting one here with Montreal coming in at 67%, and Toronto and Vancouver at 58%. Very attractive markets that people would like to buy in. And then if you're going to buy retail, which as we saw, most people are recommending they maybe sell retail, Montreal, some of the smaller markets, Saskatoon, Winnipeg, maybe they're not as oversaturated, maybe there's opportunity for retail expansion there. And then Toronto, this is kind of a head scratcher, and I'm sure the panel can probably touch on this a little better than I can, kind of why Toronto would come in at a 32% buy rating on retail. Where would I sell? And this is kind of the question. If people want to buy, somebody's got to be willing to sell. And if you're looking at this, what's the one number that really kind of jumps out at you as kind of a disconnect? Nobody wants to sell Toronto office. So the 58% that want to buy Toronto office maybe have a little trouble finding transactions. So it's going to be kind of interesting. That kind of fits into something we'll talk about a little bit later. Halifax office, you want to sell that. Calgary office, that's kind of a market that's a mix. I would almost say maybe selling Calgary office is a positive sign because the market actually has kind of stabilized, so people feel like they can actually move assets in that market. And then, industrial, no one wants to sell Toronto industrial, so that's going to be another key kind of how do you find that market to get out there and get involved in it. And then multifamily, Halifax. The one underlying theme for this, for the GTA, is that nobody really wants to sell in the GTA and everybody wants to buy in the GTA. So, if you're an owner, it may be a good year. In the U.S., I mentioned that kind of the trends all kind of fell down or kind of filtered down into the markets and the property types that were attractive. And you kind of see e-commerce for fulfillment centers, although there is some concern over overdevelopment of fulfillment centers in the U.S., kind of waiting to see how that comes out. And then, housing related to aging seniors, trying to find affordable housing through moderate income apartments. Medical office, big all across North America. And then student housing is still popular as we have the next Gen Z, we're calling it, kind of coming up. So that group will be demanding student housing. Development kind of fits the exact same thing, which is a little unique that we had both come up the same way. Now, how to address affordability? It's a simple supply-demand equation, isn't it? If you have high demand and low supply, you're going to have high prices, which we have. So how do you fix that? Well, the easy way would be to kind of try and raise supply. Demand, over the years, if we looked at a thing, there's immigration, number of people are coming of the age when they want to buy a home. So the demand is there. It's difficult to kind of cap that. But we've had certain regulations go into place to try and cap demand from outside sources, whether it be international people coming in and buying assets, investors buying assets, taking housing off the market. But is that really the right way to solve the problem? And this is something that we ran across from a lot of survey respondents and interviewees in the U.S. as well, is as we've come out of the housing bust in the U.S. in 2007, the amount of regulation, the neighborhood resistance to increasing density in their markets has really increased significantly, something we didn't see in the early 2000s. So we're seeing more restriction on supply, and it's getting more difficult for people to buy houses. And so maybe the focus should be on how do we increase supply, either through less regulation, opening more land. Land's a big component of that. Can you find the right places? And then will housing have to adapt to how people want to live? And that kind of gets down to if housing stays in this way, are we going to see more people doubling up? We're going to see more multifamily. We're going to see more multi-generational homes. And meeting each one of those needs is an opportunity for the market going forward. This kind of very interesting chart in terms of young people living with their parents. And, it's a significant percentage. And I look at this audience, this is a pretty young audience, so I don't know how many of you actually have somebody living at home, but this is something I live in fear of every day. My kids are right in that point where, they could all be home at the same time when I just thought that they were all out the door. So, it's not necessarily a bad thing. I think that, as generations, we'll get used to it, and it may become the norm. But it's just interesting to see, in the more expensive markets of Toronto and Vancouver, how many people are actually living with their parents. And then this kind of, I said, mentioned touches on the U.S. The price of building a home in the U.S. continues to go up. The home builders are facing a significant headwinds from labor costs, materials costs, thanks to a tariff on Canadian lumber, which drove up prices, that kind of hit. Inventories are at record lows. Land used to be able to go out, you'd move further out, and people were willing to buy houses there and then come in. That's not happening in this cycle. People don't want to live further out. They want to live closer in, so that option's not there. So what we're seeing is maybe the U.S. home building market looking at improving technologies to help not maybe bring costs down, but kind of level costs off and allow them to keep their margins tight. So rising technology either through prefab, options such as 3D printing, new improved systems to kind of help improve the efficiency of the building process, all kind of coming into place. And we talked about the global war of talent in terms of trade, which in the Canadian market, and then last year one of the top trends in the U.S. was a shortage of construction labor. Now, the fact that we've had 3 natural disasters in the U.S. this year, and there's going to be a requirement to rebuild those areas, is going to put even more pressure on construction labor going forward. So this is kind of, okay, so this is my solution to try and keep the kids from moving back home. Can't move back home if home keeps moving. It might, you chuckle, but my kids don't chuckle nearly as much when I mention this idea. So that's, how do we rethink real estate to kind of take advantage and move forward if we're in a market that, it's a great market, it's in pretty good shape, there's assets out there, there's capital out there, seems to be working freely, there don't seem to be any log jams. So are there new ways to kind of look at opportunities? And the first one is this: can we see a rise in places where we need more real estate? Transit is certainly an excellent way to create spots where people may want to live and work. And you have transit, you think of transit, it's a way to get from point A to point B, but usually there's point C and D in between. So you have an opportunity at each one of those to kind of create some type of, whether it be shopping or living or office, all opportunities kind of put there, and it helps areas develop because you don't necessarily just go A to B, you can also go B to A. So suddenly you have a whole new market of people might come in there. So that kind of fits in with this rise of placemaking, which we first introduced last year as kind of community building. It's more than mixed use. It's kind of taking all the uses and making the sum of the parts greater than the whole, so that you have the right mix of residential and services and retail and office, all kind of right there together. And people want to be there, and it kind of generates a vibe that makes that an attractive place. And that rolls a little bit into the 18-hour city, which 18-hour cities, you can't create an 18-hour city. It kind of has to evolve. It has to have those amenities and kind of that attraction that people want to be there. But if you kind of do this rise of placemaking, that kind of helps along that way. And maybe an 18-hour city doesn't necessarily have to be an 18-hour city. Maybe it can be an 18-hour neighborhood. Maybe it can be an 18-hour submarket. It can be a portion of that. So finding places like that, I think, will offer new opportunities going forward in next year and the year after that. Because these are long-term developments. It takes a while for this to happen. So looking forward to kind of see how these all three kind of come together to create new opportunities. And that, I'll roll into kind of the U.S. markets. And the top 10 this year, out of the survey results, kind of reflect how this is happening in the U.S. Seattle was the #1 market. A lot going on in Seattle right now. But we had Salt Lake City, Fort Lauderdale actually enter the top 10 for the first time. And I would argue that these are markets that have kind of hit that opportunity. They're newer markets. Fort Lauderdale's adjacent to Miami. It's an affordable alternative. I was in an event in New York yesterday, and somebody said, well, you know why Fort Lauderdale jumped up? It's a lot of the hedge fund people leaving Connecticut, New York, moving to Florida for tax, no state income tax. So they're kind of seeing an attraction there. Dallas-Fort Worth, the two Texas cities still in there. But we're seeing a rise in the number of these smaller cities kind of getting attraction and getting more interest. And the length of this cycle is making that possible because people have time to do the proper due diligence. They're not just jumping in. They have time to take a look at it and get comfortable with it. And that kind of fits here. We look at the aggregate population of the top 10 markets. And we see we're up about 57 million in the U.S. in the top 10 markets in 2010. That's when everybody was going to gateway markets. They all wanted to be in a gateway market. Now we're seeing more of these secondary, smaller markets get more traction. We're down to about 37 million is the aggregate population of the top 10 this year. So how do we reinvent real estate? This kind of ties into that whole technology issue. And I think this is kind of a chart that we first started looking at last year, and it's a real estate tech global financing history. Have a group that actually tracks this now, which makes it very interesting. One time last year doing one of these presentations, I heard someone make the comment that real estate actually, prior to the last couple of years, was spending less money on technology investment than the commercial fishing industry. So real estate has been slow to kind of adopt technology, but now it's coming, and it's coming fast. It's not just into the properties themselves, which is a big part of it. How do I operate my building more efficiently? How do I keep my tenants happier? It's kind of how do I use all this information that I have? You think of a building and all the tenants, the coming, going, the uses, everything that's going on there. It's now possible to collect all that data. And if we can collect all that data, then what decisions can we make that will be better either for the tenant or for the building owner or the manager, leasing broker? How can they utilize that to more efficiently and more profitably operate that building? 2018 kind of market outlook for Canada. One thing that comes up here, which also came up in the U.S., there's no red dots. We usually, we've got dots as green, yellow, red. And I think that speaks to how stable the market really has kind of become across all of North America. There's opportunities everywhere, and people are being more granular about looking for those opportunities. So we kind of have this, if you want to look for something somewhere else, you can, and there's an opportunity to do that. So what are our best bets? We kind of come up with this, and we give you this 107-page report, and you sit there, what should I do with it? Well, kind of what comes up as a consistent theme is senior housing is a great opportunity, kind of get out there and do that. fulfillment and warehousing, which maybe investing in it is easier than me trying to say it. Toronto office, continue to put up new Class A space, which people are willing to pay for that, and they continue to move into it. It'll be interesting to see how some of the existing back space gets reused. Maybe it's multifamily, maybe it's another office use. One thing we haven't seen in this cycle is a lot of people willing to pay down because of the desire and the belief that the quality of your office space is how you attract and how you compete in that war for global talent. Prop tech is something that's going to grow exponentially, I believe. Everyone's talking about it. How they choose to implement it will be different, but there's a great opportunity for figuring out how to collect the data, how to use the data, how to implement that information that you get from that. And then it's not just, and it's throughout the entire spectrum from building, design, implementation, and then building communities, which is just taking advantage of kind of putting all those pieces in the right place to kind of make it all work. So that's what I have, and we're going to do this truly kind of the way that we now do our communication in the U.S. with our president is, I should have just tweeted all this about midnight last night, and then we'll have a panel of experts who will spend the day telling everyone what I meant by that. So with that, I thank you for your time, and let's bring on our panel.
Thanks very much, Andy. Insightful and interesting analysis as always. We're now going to move on to the moderated panel part of this program. And with that, I want to introduce our moderator, Nadia King. Nadia is a partner at PwC here in Toronto, is also a member of the ULI Toronto Advisory Board and our former treasurer. Nadia King.
So thank you for that, Derek, and good morning, everyone. I have the pleasure of introducing this esteemed panel that we have with us today. To my immediate left, we have Michael Turner, Executive Vice President and Head of Canada, Oxford Properties, where Michael is responsible for Oxford's Canadian investments, development, and management operations across 5 asset classes, which represents 50 million square feet. He's also a member of Oxford's Investment Committee and Executive Committee. Prior to joining Oxford, Michael spent a number of years at a global real estate services firm where, as Executive Vice President, Investment Sales, he led significant transactions across all asset classes in North America. He was formerly past president of the Greater Toronto NAIOP and is involved in several charitable organizations here in the city. Next to Michael, we have Paul Morisuti, Executive Vice President and Executive Managing Director at CBRE. Paul comes to us with over 25 years of experience and leads CBRE's valuation and advisory team here in Canada. Paul has a wide range of background encompassing all facets of institutional real estate and land development. Paul is a member of the Royal Institute of Chartered Surveyors and sits on the advisory board for Schulich School of Business MBA Real Estate and Infrastructure program. He is also a director of Artscape, where he chairs the development committee, and recently became a member of ULI Toronto's board as well. Next to Paul, we have Eve Lewis. She is the founder of Urban Nation, a Toronto condominium market research company, as well as the founder of Market Vision Real Estate Corporation, a residential condominium marketing group. She is also the president and CEO of Woodcliff Landmark Properties, which is a real estate company focused on restoring and repurposing commercial heritage buildings here in the city. And finally, we have George Karras. George is a professional engineer and an entrepreneurial leader in the use of information technology in the Canadian property markets. George founded RealNet Canada in 1995 and currently leads Real Strategies and is hands-on in the creation and the acceleration of the next generation of technology to help the real estate market. George is a member of George is a mentor to emerging industry leaders, a past president to Toronto NAOP, and the co-founder of NAOP Rex Awards. Welcome, and thank you for joining us today, everyone. Now, you've all had an opportunity to listen to Andy as well as read the report. So what I wanted to do is give you all a couple of moments to reflect on what you've seen and heard to date. So Michael, for no other reason other than the fact you're sitting next to me, why don't we start with you?
Well, thank you for that. So I was reviewing the report last night, and I was listening again to some well-articulated remarks this morning. And I thought, what might this report look like in 10 years' time as compared to today? And I think some of the words that are being introduced in today's report are really going to set the direction for the industry. And it's certainly some of the themes that are going to guide Oxford's future. And it's really around the elements of placemaking, people, and community. And I thought about this room this morning and said, I wonder how this report might be different if it was for the hospitality industry. And we have a lot of numbers in this report, and it's very impressive in terms of supply and demand and capital and cap rates and so on and so forth. But I thought if it was hospitality, how much more emphasis would there be on what's the customer experience? What do the people think? Do they like to go into this hotel or that hotel? And so I guess if I could share any themes, it would just be that I think the report will evolve just as the industry's going to revolve. Right now, it's a reflection of the people's priorities in this room, and I think that's going to change.
Excellent. Paul?
I thought the presentation this morning was excellent. I'll jump off of some of Andy's comments. You know, we're on the commercial real estate side, we are over 8 years into an incredible bull run. The question that does arise more and more frequently, as it was alluded to this morning, is have we peaked? And just to put things in context, to consider where we are today, the first half of the year, Canada grew GDP growth faster than any G7 country in the world, or any G7 country. Virtually every economy in the world right now is growing simultaneously. First time that's happened in 10 years. In the Canadian sector, fundamentals across the board, perhaps with the exception of Alberta office, are very good. We have, if you look at multifamily, industrial, office, even hospitality, our vacancy rates in the major markets in Canada are either amongst the lowest in North America, or in some cases they are the lowest in North America, and by a wide margin. At a time when, on the back of that strong growth in the first half of the year, Bank of Canada raised interest rates twice, and despite that, cap rates actually have compressed. As recently as the third quarter, they've come in. So fundamentals are excellent. The market does feel like it's pretty tightly wound up. And people are beginning to talk about, well, just by virtue of the age of the cycle, are we looking at a recession in another year or so? And I thought, you know, Michael looked forward. I'll look back just very quickly. If you consider the last 3 recessions in Canada, the worst by far was the recession of the early 90s. That was caused by wildly undisciplined new supply and highly levered private ownership. Today, outside of Alberta office, we don't have a new supply issue, and ownership is extremely strong, very disciplined use of debt. In the early 2000s, the dot-com bubble burst. And regardless of what you think about tech stocks perhaps being overvalued today, tech and tech demand in 2017 is entirely different than what it was in the early 2000s. And then in 2007, particularly in the United States, you had thousands of people who earned $30,000 a year buying $800,000 homes with no money down. Those mortgages, which were rated AAA, were packaged and repackaged, sold to every financial institution in the world until the whole thing blew up. We do not have that situation today. So there's not much historical precedent that we can look to for a recession. None of those conditions are in place now. And really, other than the unpredictable or other than some kind of black swan event, we think this cycle that we're in could easily be extended for a few years.
Great. Eve, over to you.
Okay. I should have taken a lesson on how to do this, right? Okay, how do I go backwards?
Try the red one.
There you go, perfect. Okay, great. It's interesting that what is coming up is, top of the cycle, how far are we going to be able to persist this, and caution. So here are the numbers over the last 10 years, and as everybody knows, there's been an astounding growth. Toronto, on average, is less than a 20,000 square foot new condominium market, and over the past 10 years, last year was over 26,000, and this year, at the rate that we're going, it's going to be 35 to 37,000. So we're now into beyond cautionary, and for those of us that have been in the industry since the last big recession, which is probably not that many people in this room, there's intrepidation would be probably everybody's concern. Having said that, we've more than doubled practically in the last 10 years in terms of volume. As much as everybody talks about how difficult it is to get zoned and planned and under construction, there has been a lot of that. So you've got year to date till the end of September, and then you have the projections till the end of the year. So I think everybody is wondering where is it going to go? And I think no matter what, it's not going to sustain what it has done this year, and what is going to be the impact of that. Affordability also came up as to be addressed, and I think that if you look at what the values have gone up in terms of the average price of a one-bedroom, 2 years ago it was $312,000, now it's $420,000. It's gone up for 34%. And not only that makes it so that people can't afford to have to pay the same amount of their mortgage in that same time period. It's gone up from $1,150 to $1,500. But here's the real kicker: in January, with the new mortgage laws, because you have to qualify for a 5-year mortgage, it's going to be $1,900 for a resale. Now, in new sales, we've always had to do that, but then people have 3, sometimes 4, sometimes 5 years to, increase their deposits. If they're young, they're going to be making more money the next year, but this is going to have a significant impact on the resale market. And then the last one is interesting because we also wanted to talk about affordability in terms of renting, and rents have been going up significantly as well, and particularly right now because rents are actually a reflection in large part on supply. And as you can see, the completions are way down for this particular year in 2017, so rents have continued to bump as the completions for condominiums, which really are most of our supply of rental product and affordability in Toronto. As they go up, then you'll see the tapering off on pricing. So as an overall, there's a caution on volume and how it can be sustained too. If you don't have the same amount of demand and volume, then that's going to have an effect on pricing, and ultimately it's going to have the same effect on rental values as well.
Okay, thanks, Eve. George, over to you.
First of all, way to go, Andy. I think that was a great report. Again, we had a little chat with Andy just when we were starting up here, and he said, you're in this and you're in the weeds, and you see this same stuff that you may have seen last year, seeing it again. In fact, your number one theme, the same as last year. What I saw, maybe if I did a contrast and compare between last year's report and this year's report, I think was a really important additional dimension that was added. You have to look carefully, but that was along the themes of innovation and technology. And I think last year's report, when we were talking about technology, we were really focusing on technology's impacts in the business of real estate. And I think this year's report really started to touch on some of the technology's impacts on the business of real estate. And I think the one point in the business was housing basically at a technology tipping point, and really pointing to things like off-site construction, which is really kind of where robotics and material innovation start to impact the marketplace. And on the venture side, we saw this year the first tech company reach, two-year-old company reach $1 billion valuation in that space, tech CEO, disrupting construction. On the innovation and impacts on the business, I think what was really interesting, was looking at Jeff Bezos going grocery shopping this year, and deciding what the hell, let's buy Whole Foods while we're at it for $13.7 billion of essentially pocket change for Amazon. And I think, in fairness, the report was cut and delivered to us a few weeks ago. Last week, Amazon introduced Amazon Key as a technology on the 25th. And there's a whole new capability that's now available through Amazon for 80 to 90 million of its prime customers, who can now electronically opt to open the door for the Amazon delivery person, and with their proprietary cloud camera, let you watch the delivery person put the stuff in your home and have it recorded for security reasons. So I think if you put this together, you go put that together. Amazon's current business, you got Whole Foods, you have this Key, and you have their Echo device, so you have ears and eyes in your home. Where's that going? So I think where we're at now collectively, is in the knee of an exponential curve on a number of these technologies, which are all highly connected. And I think they're moving from a phase of being deceptive to being disruptive. And the sum of these is now going to be absolutely impossible for you to ignore. The only decision you're going to have in this is going to be what role you're going to choose to play in this. And for what it's worth, my choice in this is to actually found our labs here in Toronto, which is Canada's first PropTech seed stage venture platform. Comprehensive platform that allows us to really own the problem of housing and commercial real estate and solve it through companies that are technology enabled, that we can prove locally and scale globally. And I think your point on PropTech was an interesting word. For those of you who have not heard the word PropTech before, like FinTech, it's being invented, I think, as we go. And it really describes kind of the innovation that we're going to be seeing, where property and technology, are intersecting. And I think we'll probably see that word a bit more in 2019.
Oh, that's great. Thank you. So what I find interesting as I was listening to your reflections was that I really realized that 2017 actually really went through a huge public policy shift. So OMB reform, interest rate changes, new mortgage rules that are coming in, rent control, inclusionary zoning, et cetera. Now, given all of these shifts, would love to get your thoughts on how that's going to impact the real estate market going forward.
So specifically these policy changes. I mean, I was at an event on, I think, Tuesday night or Wednesday night, and the same question was asked. Some of the policies, particularly here in Toronto and Ontario-wide, I think they're populist. Those tend to be short-term thinking and bad policy. So if everybody, I never go to an event where people don't talk about affordability. I don't think that the public understands, and quite frankly, the government understands that managing the bureaucracy of approvals and entitlements and so on and so forth, I think it probably costs 20 to 25% of any project by the time you factor in how much more you have to carry your project, consultants, and so on and so forth to, I mean, you need to hire experts who can liaise with government. It's quite extraordinary. So that's going to be an issue, and I think we're going to have to find ways to assist the public sector to become more efficient, because they are going to be a contributor towards having unaffordable homes or affordable homes. And the element of rent control, I don't think anybody in this room would disagree with the fact that if you control rents, you're going to supply less housing. And so there's been countless studies around the world about the effectiveness of this as a policy, and it's being shown every single time to be a really bad thing to do if you want to increase the stock of housing and maintain quality of affordable options. So I think we're not pleased with some of the policy decisions. That's the environment we're in. We're just going to have to find a way to operate in there and build the best relationships we can with stakeholders at City Hall and Queen's Park and so on and so forth, and operate within this landscape that they've laid out.
Okay. Eve, did you have something you wanted to add?
Interestingly enough, I think Urban Nation did, over the last 3 years, more rental studies for developers than they did condo studies, because everybody was looking at investing in that market with the new program that the city did, where they were going to give you a tax break on the property taxes for the next 10 years. And then they come up with the new program, you know, in terms of, you know, capping, you know, making all rental properties rent controlled. And now, of course, everybody is now converting from, you know, increasing the new build rental product and now going back to condominiums, which have in large part, you know, certainly downtown, being served by investors who have provided the rental stock for this city. So we've got a number of different policies fighting each other, and it's unfortunate that after, you know, really there hasn't been a rental program at all since 1981 with the MURBs, and now something was finally put in, and then the provincial government comes out with a program that is definitely going to compress the supply of certainly new build product.
Absolutely. Go ahead, Paul.
I mean, since we're talking about rent control, I would have maybe a modestly different take on that. Rent control, I think, is bad policy. I agree with Michael. It wasn't introduced because it is good policy. It was introduced for political reasons. I think there is this perhaps perception that because of the expansion of rent controls, anyone who is thinking of building purpose-built rental no longer wants to do it, and it's going to have a long-lasting impact on the development of new rental product. I'm not convinced that that's true. I think that, you know, does this cause some pro formas to pencil out a little differently? Yes, it does. Does it dampen the price of land if you're going to do purpose-built rental? I think yes, it does. But when you look at the institutional demand for good quality rental product, which is almost impossible to buy at quality and scale, I think there are a whole host of developers across the country and institutions across the country that want to develop this product, and there's a huge rental demand for it as well. And I think the shift from focusing on rental back to condo, a couple years ago, it felt like the condo market had kind of peaked, and so the rental market looked like it was accelerating. Okay, we'll shift into it. Today, the reverse has happened, and if you're building a mid-size, you know, 250,000 square foot condo in Midtown Toronto today, the profit is somewhere in the range of $20 million. So do you want to earn $20 million and get in and get out really quickly, or do you want to build to a, I don't know, maybe a 5% development yield on the rental side? I think the pendulum has shifted, but it won't stay there forever. And I think we will see over the longer term a reigniting of purpose-built rental.
Okay. George, did you want to add something?
Yeah, I want to pick up on, so Paul's point there on the politicizing of some of the policies, I think, is where some of the issues we face are. And you know, if you go back to a formula, outcome of the market is a function of the events that we face and our responses. When the responses of policy create new problems, I think we have to change our approach to this. It's like the Einstein, quote of, the same thinking that created the problem is not going to be the thinking that solves the problem. And Larry this morning said, be nice on policies. And I think the issue here is housing as a framework has a number of different governments that are involved in it. When politics come in, as clearly they did with fair housing, things get messy. And you look at conflicts that I think are present, and you can look at the amming up of our intensification metrics from 40 to 60%, and at the same time taking away the OMB, which I think was responsible for something like 70% of the approval supply in Toronto last year. So these are two things that are really going in opposite directions. Part of that, I think, is politics. Another one that Eve touched on here, which is very quiet, OSFI B20 guidelines, which will be coming into effect, which, OSFI was a really important player for all of us in the great financial crisis, because we were really lucky that they put in place the rules that kept our banks, in check. And now this is another one of these demand destruction pieces, which is fair. So if you're going in for your new, mortgage, you know what the rules are. But we have a lot of pre-construction condo that's now pre-sold, and over the course of the next 5 years, that policy may actually put in place an entirely new risk that didn't exist before. So, what you have here, I think, is a real problem that, we shouldn't be expecting policy solutions to fix everything. And I think that's where real innovation, really needs to step in. And that's not likely to come from government. It's likely to come from industry and consumers.
Absolutely.
The OSFI mortgage regulations is one of those things that I think in theory nobody disagrees with. In theory, adding some resiliency to the market and removing some potential volatility is a good thing. If this happened 25 years ago, I would have said, well, this is just common sense. It doesn't need to be regulated. The problem, as usual, is how do you thread the needle and the threat of unintended consequences.
Yeah.
And this will kick in January. Now, effectively, the entire buyer universe is covered. It's not just the people with under 20% down. And my concern with it is if interest rates continue to tick up a bit, and we'll talk about them later, but I don't think they will too much, but I am worried about the housing market in Vancouver and Toronto being vulnerable to almost anything. And if this affects the psyche of the market, if it causes speculators to run for the exits perhaps, I'm worried about what that could lead to. As I said, in theory, I don't like housing being treated as a commodity and being traded, and I don't like the speculation in it. But it's, policy's pretty hard to, as I said, to thread the needle, and that's the concern here is, sounds good on paper, but what will it really play out like?
Right. Well, and you've all hit on basically the number one trend, and unfortunately it's a recurring trend, and that's the affordability concerns that we have. So we've talked about some of the policies and that sort of thing. But every panel we seem to have affordability concerns constantly comes up. So what do you think is at the heart of the issue? Do you really think it's just a supply and demand issue? Do you think it's the political landscape, or are there other factors at work here?
Maybe I'll take a shot. And I think there isn't one factor, but Econ 101 still matters. You showed 30-some-odd thousand new sales this year. You think about announcements like the federal government saying we're taking immigration from, I think, 300,000 to 330,000. The long-term impacts of things like the Greenbelt and restricting land supply, regulatory creep, and it takes longer to get everything done. And I mean, the construction industry, there's good data on this. There's been absolutely no productivity increases in the industry in like 75 years. It's a 12 trillion US dollar a year industry. It's probably the only industry in any sector of the global economy where there's been almost no productivity increases in almost 100 years. And in fact, the numbers I've seen in the last 10 to 15 years, productivity's gotten worse. I think that's going to be a huge problem when you talk about increasing immigration, the amount of supply that people want to buy, and the capacity constraints that a region like this has. As George said, it's going to take some real innovation. And so maybe there's some low-hanging fruit there, I don't know. The industry as a whole has spent less than 1% on R&D. If you're in a different type of company in, let's say you're Procter & Gamble or Johnson & Johnson, you spend 30%
Exactly.
on R&D, and construction spends, it might as well be zero. So maybe there are some real opportunities, but I think those are going to take some time to get at. And in the meantime, we have a whole generation of trades who are, many of them are second generation, I'm going to call it, contributors or worker bees to whatever skill that we're relying on, and the third generation's not coming in. So that crunch is going to be like a bullseye for us for the next decade, and I think we're going to see 4-6+% cost escalations year after year. This is going to be a problem, and it might take 10 years to solve this, and there will be opportunities to move the needle one project at a time, one innovation at a time, but let's face it, delivery cycle's like 4 years.
Yeah.
So the feedback loop in the learnings is, like, it's slow. Now, and George can talk about it, there's new ideas and new technology coming into the space, but it's going to take some time, and in the meantime, I think we got cost pressures, and I can tell you that we face that as an organization in every global city that we're working in.
I'll jump on that. I mean, the issue of affordability, I think the first thing is to just acknowledge there's no silver bullet, there's no panacea. I hope in Toronto it doesn't play out the way, public transportation has, where we kind of ignored it for 20, 25 years until it became a problem of such magnitude that now we can't get our arms around it. So I think something has to be done every year to address this. I'm not sure how much real progress we're making. We've heard about inclusionary zoning for many years now. I still don't know what the rules are. But you mentioned in my bio, I'm on the board of a group called Artscape, and we help find and build homes for artists so that they don't get all pushed out of the city. And we've partnered with a whole variety of developers, many of them in this room, even included at Waterworks. And one of our projects is partnering with Tridel and Hines at Bayside on the waterfront. We're going to operate 80 rental units the city will own. And those projects that we've been involved in are an absolute win-win-win. The city is thrilled with the outcome. I think in every case, if you ask the developer, they're very happy with the outcome, and we're happy with the outcome. It's not a huge amount of housing, but if we could expand that formula a little bit more and do it annually, that might help.
So I've heard a lot about innovation and changing sort of the way that we work, which I think is important to sort of address some of these affordability concerns for sure. On the flip side, those that literally can't afford to be in the city are also thinking about how do they live and how do they work and where do they want to live. So Andy mentioned in his presentation multi-generational homes, the concept of co-living. Do you think those fundamental changes are going to change how we continue to build this region?
I think, so if I can chime in on co-living to begin with. We haven't seen it here. It's an interesting description. Sounds very technical. It would be, we have student housing at the early end of our, life cycle, and we have seniors living at the tail end of the life cycle, and co-living is a term that's being used to describe, a condition where in very expensive urban markets, and you've seen that in New York, you've seen in San Francisco, you've seen it in London, you're no longer having your own unit, you're sharing that unit with others. And there's companies who have made some interesting, money raises and trying new platforms out there. I think it's not cheaper, it's just a lot more flexible and it's kind of everything. So We Live, as an example, will give you everything down to your fork, and you can determine whether or not you want to stay there for a day, you want to stay there for a week, whether you want to be there for a month and then share another accommodation. It's entirely flexible, and you have all your stuff. So I think it's an interesting idea, and it's largely innovation is going to be caused by the conditions around it. We haven't seen it here. I think the conditions are kind of ripe to try something like that here. And on the other side, why do you do that is because Andy's RV that's going across the country so you can duck your kids. If your kids are back at home, it's because they have no place to go. And I think that's where your second point about multi-generational housing comes in. If that housing stock, that resale home, cannot get recycled through resale, it will get recycled through innovation. And I think that's going to be where you might see on that trend is an increase of renovating the existing house stock to deal with the inevitable that the kids are there, or they're taking the keys to the RV and they're going cross country. So I think those two are kind of hand in hand, but we're probably seeing more of the latter than we are of the former right now.
Mm-hmm. Eve, did you have anything you wanted to add to that? No? So one of the impacts that we've actually seen as a result of affordability is the 18-hour city. So individuals that can't necessarily live or afford to live in the city or don't necessarily want to are moving out and branching out to other areas. Now, this is a concept that is very much alive and well, I'd say, in the US. In Canada, it's just starting to emerge. We're seeing it a little bit in Montreal, we're seeing a little bit in Vancouver, and a little bit in Calgary. But any thoughts or predictions as to where perhaps the next 18-hour city may be in Canada?
Yeah, I mean, it's like we heard in the original presentation. These things are long duration. They take a long time to play out, so I don't think you'd have to go out on a limb and say, where might you see that in a decade? Mm-hmm. Just look at a trend line, and if it stays along that, I think you'll see the fruition of the concept you're talking about as an 18-hour city. Certainly Montreal is experiencing a renaissance, and it's going through going vertical in its downtown, something that the city started doing many, many years ago. And Montreal's also benefiting, I think, from the investments that both the public and private sector and educational institutions have made in technology. And I think the theme is going to be around that. So if you talk to some of the folks who are hunting for the talent to build the software that's seemingly taking over our lives and our world, they're going to places like Denver and Salt Lake City and so on and Austin because they can find a programmer at $100,000 who can afford to live in that jurisdiction as opposed to somebody in the Bay Area that makes $250,000 and still can't find housing that's affordable for them. Yeah. So I think it's really going to be, where is the talent? So perhaps you could even put, it's not very dense, but maybe you could put the whole KW area on that list. I don't know, Ottawa to me always feels like a 5-hour-a-day city as opposed to an 18-hour-a-day city. So, but it has.
No offense to anyone who's from Ottawa in the room.
I love Ottawa. I just always feel like it lacks animal spirits, I say. So, the cities in Canada that are, call it, 1 million or less, those will continue to evolve if we grow, of course. But I think its talent is key, and how are they orienting their economies? Are they orienting their workforce and their offering to the world of the future or the world of the last 20 years.
Yeah.
That's what's going to drive this theme of 18-hour cities.
George?
I agree.
Excellent. As long as we're all in agreement. So Michael, you actually touched on one of the newer trends that we saw this year, which is the war on talent. So Eve, on one of your slides,
Sorry, the what?
the war on talent. So attracting and retaining top talent. So one of your slides actually shows that there's no doubt there's been a condominium boom in the GTA, and some of that is fueled by individuals that want to live, work, and play very close in a very restricted sort of area from where they live. That being said, though, we do see a lot of development that's happening in the 905 and some of the other suburbs. So as a lot of these companies are dealing with the war on talent, how do those areas in the 905 continue to be attractive to a labor force?
I mean, a very smart man who honed in on this like super quick was when we were working with and giving Ed Clark our advice on the whole Amazon pursuit, because we've dealt with them in 5 jurisdictions now, and we're building a building for them in Vancouver. And so he did his homework and he did his math on the back of a napkin and figured out, well, you real estate guys are like you're only 8 to 12% of their overall costs of, Amazon's COGS, if you will, and talent's the big one. And if they're in this region as compared to all these others, when he looked at the cost of securing that programmer and so on and so forth, they'll save $600 million a year by being here as opposed to somewhere else. So I think talent is huge. Once upon a time, when we completed a lease, we would go and have a conversation directly with the facilities department at ABC Corporation. Now, that whole exercise entirely is driven around HR, about people procurement, culture, what brand you want to represent. So yeah, like the real estate people are in the room, but they're just fulfilling what HR wants them to fulfill, because HR is not equipped to facilitate that entire exercise. And so I think the war for talent's huge. Downtown's clearly winning. But certainly, I wouldn't count the suburbs out in certain areas. I mean, we own Square One. It's 110 acres, and we have a high-order transit line coming there. And you can look out at any direction at Square One, and you see 40-story towers. So we're seeing the urbanization, if you will, or going vertical in suburban town centers and nodes. I think where you're going to have a challenge is office campuses where people went to in the 1990s because it was cheap. Because guess what? It's likely those back office functions, those are automatable functions anyways, so those jobs are going to disappear for a lot of those roles. And there's no amenity, there's no spirit, there's nothing there to attract talent. So again, it's all about the people, and we'll be betting on properties where people want to be.
Yeah, I think on Michael's point on the jobs. Christine Lagarde had a panel on the new economy, the first time ever last year, and the question was around infrastructure. And the way it was answered, I think, was ties into Michael's comment. Was what is infrastructure? You're building for the future. So you think about what the jobs are like in the future. And when there was a discussion about that, it's like, well, do you spend $7 billion putting a train from here to here? The answer was no. And a lot of it was national Wi-Fi and soft skills, education and soft skills as an infrastructure. Why? Because then those jobs move to those other places. And I think we have to really be thinking about that. The things that lie ahead, and as we're building infrastructure, Michael said it, it's like, are we building infrastructure, to support an economy in 1980, or are we building one, for 2050? And, dematerialization is an interesting, word. So if you think of the mass of our economy, weight, physical weight, between it in 1980 and today, and where you think it might be in 2050. So I think the place making, don't underestimate. And we've said, well, telecommuting, it didn't work. We saw that in the '90s, and it's not going to happen. It's different. And I think you have to really look at the churn in the job market, and then look at some of the things that will come, that the technology that we need, the jobs that we need to be innovative. We have a finite capacity of that innovation ecosystem here, and it's got to grow. In fact, the innovation agenda from the feds, when that came forward, the CVCA, Conference Board, all looked at it and said, look, this is really good, except you don't have enough skilled talent in our innovation ecosystem. That's why we should boost skilled immigration, up to, actually, we wanted over 400,000. But I think when you come back down to this group, where are they going to live? And so I think don't discount the fact that if they can't live here, and you can be in a KW, although that's becoming the same thing, or some other place which is not too far but ripe with the ability for affordable living, and you can move those jobs over, that can happen. And it can happen relatively quickly.
Absolutely. So it's an interesting concept because we're talking about a period of innovation and we're in a period of disruption, I'd say is what we're dealing with. So finding that talent is important. I was actually reading an article this past week that was talking about how Toronto was struggling a little bit with being able to attract and retain key top talent because of the affordability issues. So I sort of thought about that, and then also thought about Toronto's bid to become Amazon's headquarter central. So my question to all of you is, do you think we actually have a shot at winning that bid?
Yeah.
Who first?
I think it would be, if anyone can take on the political wrath of Donald Trump, it would be Jeff Bezos, which I think it would be if you moved HQ2 outside of the U.S. But I'm not entirely sure it's a great thing, to have that here. I think we, instead of working and everyone going to work for a big Amazon, I think we should be building them. I think we should be building the next Amazon here, and I think a move like that will take a big draw on the talent that we have here. We can look at that as a good thing in the short term, but I would take the position that I think we can do better.
Paul, it looked like you were nodding that you thought we had a shot.
My view on it has changed since it was first announced. I think we have a very real shot at it. Jeff Bezos is the richest man in the world, and Amazon's third, fourth largest company in the world, and growing quickly. And there was concern originally about, will he really move such a significant facility outside of the U.S. and risk a Twitter war with Donald Trump or something worse? I don't think he cares about Donald Trump. No. And I'm not sure Trump could do much in any event. I think ultimately he'll make a decision based on what's best for Amazon. And if you go through all the variables that I think they're considering, and I don't know if you've seen the bid book that Toronto put out, it's on the website if anyone hasn't looked at it. It's excellent. As Michael mentioned, I think one of the factors that I read in there was, I think it's the healthcare savings. By virtue of moving to Canada, approximately $600 million a year in savings just by virtue of healthcare. So we are not going to be able to offer the same types of incentives that other regions in the U.S. can. But if you look at every other variable, I think we score really high. Do I think it's going to happen? I'd probably say no, but I think there's absolutely a chance that we could win it.
Okay, well, that's great.
I think what's most important is everybody's been fighting to have Toronto on the world-class list, and I think just the fact that we're participating in this has put us there, and it doesn't matter if they come or not.
No, that's fantastic.
We'll figure it out. It's a great town.
No, well, time will tell. So I would be remiss if I talked about Amazon and I didn't talk about retail. As someone who sat in an Uber coming down to this event today and buying clothes for my daughter on Amazon. So there is a view out there that retail, in the traditional sense, is perhaps dead. Any thoughts on whether there's any truth to that? And if so, how are these retailers evolving to ensure that they remain relevant going forward?
So I'll take a shot at that. I mean, retail in a traditional sense is dead. Have you been to Yorkdale this week? That's probably
I couldn't get a parking spot,
exactly.
actually.
So I'd answer that in a few ways. Is retail as an industry being disrupted? 100%. And so if anybody in this room has a retail portfolio and is saying, no, it's not, have fun with that, the outcomes of that as your philosophy. We're just getting through the backfill of Target's bankruptcy. That was 20 million square feet of space on the market. I think the numbers I've seen is about 12 million of it has been backfilled. So maybe there's another 2 or 3 to go that's under construction or isn't quite there yet. And now along comes Sears. It's not like it's a surprise. We've been waiting for this for years, anticipating this would happen. And another 20 million square feet is now on the market. So in 2004 or 5, we took the view that we didn't want to be in the B mall business. And we set up a great little company, but we let other people have that company. It was called Primaris REIT. And we said the number one assets in the trade area is going to be the future. And that's the pony that we have been riding. And I think it was the right trade for us to have made. But there's no doubt that the retailers are focusing their capital on technology. They're focusing their capital on a profitable box, whereas it used to just be all about sales and market share. Now they want profits. And the interesting thing that's happening is about what is the contribution of the store to the entire sales ecosystem for the retailer. And so when you go digital, you have like way better analytics than you ever had before. Well, as a landlord or operating a retail offering, we have way better analytics on the customer as well as what we think the customer's contribution is to, say, that Lululemon sale in the entire area, whether it comes digitally or physically, than we ever have had before. So this is evolving. Retail's being disrupted. And there's going to be opportunities in this. I mean, we have 900 acres of surface parking in our retail portfolio, and we'd love nothing more than to not give away free parking and instead solve an affordable housing problem. So it's going to be a really interesting next 10 years. And if retailers themselves are not evolving, they're going to die. And I think it's a very exciting time in the space.
On that one, on the evolve or die, I think we always look at technology as the thing when we talk about the impact. It's not necessarily the technology on its own. If you look carefully, it's when the technology is married with a new business model. And this is actually a really good session for me this year because I've got no slides. It's a real moment of freedom. I was tempted, and I said, as an example, to this very point, Apple introduced the AR kit in September, which then allowed augmented reality. So I was actually going to try to do one of these here, but I said, no, it's through freedom. So we'll talk about it. You have an AR capability now across all iOS platforms. Not lost on the likes of an IKEA. Anyone use the IKEA AR app? I'm going to show that today. So there's IKEA, furniture manufacturer. You fly into any airport around the world, there's these blue buildings and that are right near the airport. So now with the IKEA AR app, there's 2,000 SKUs of IKEA furniture that we could literally say, like, here it is, and let's put a new chair here, and I can walk around, and it's to scale, and I can pick from 2,000, which is a really interesting evolution for IKEA's business. What's really interesting is that same technology was also used by House. Anyone here on House?
Yeah.
You could admit it. It's okay.
Yes, it's how I built my house.
It's how you build your
Actually,
house.
Yes.
Okay.
Yes.
So now this is where the technology meets the business model. So House has the same AR capability, only they're not 2,000 units of IKEA furniture. They're 500,000 different pieces of furniture, and it's to a community of 40 million people that are there. And I would argue, House knows what you like way better than IKEA knows what you like. In fact, they may know what you like more than what you know that you like. So this is where real disruption, and this is, weeks old, months old, let's see what it is. So now there's an house, which is now a new disruptor to the furniture business, $100 billion a year, to IKEA. So retail, is retail dead? No, it's not dead. But, and I think Bezos had a great line, which I think is appropriate to this. He said, your margin is my opportunity. And I think this is it, is now in this space, is that there's a constant race for, getting into a business that you may not have been before. And that's going to be, likely the sum of, a technology that's emerging with a net new business model that's attached to it.
So it sounds like creating what I'll call a destination and evolving is really what is going to make it in the retail.
I'm not
going
sure.
forward.
Like
Sure.
House
And an
has,
experience.
And the experience.
that's
sure.
that's great. That's what we got to talk about is the experience. And I think whether you're software or you're in the real world, it's your experience. But horses for courses. If you're out there looking for cheap, and you know what you want, you can say what's your best experience in that, but that's what you're going. So I think it's a world of multiple silos for multiple solutions.
I think. Go ahead, Michael.
Even the retail disruptors are being disrupted. So Zara is an amazing company, and I've always described them as a technology company attached to a logistics expertise, and they happen to be in the apparel business is how they express their expertise. And if you added the cloud to Zara, you basically have Amazon. That's how good they are. So one of the things that they did, and they do better than anybody else, is their ability to spot design trends and to get those from the world onto the production floor, into the store shelves, or into your home in a package, like in a matter of weeks. There are now people who are working on distributed ideas so that anybody can be a designer for any of its own purpose or fulfillment. So, Paul is always quite progressive. So I take a picture of what Paul's wearing, and I can add it to this, that, and the other thing, and now I can contribute.
You look great, Paul, don't worry.
So Zara's designers are going to be designers from anywhere as a possibility. So I don't think anybody can stand still in any industry and think that somebody, as George just said, like our margin is somebody else's lunch. So we better be aware of that because somebody else wants to eat that lunch.
To the point of margins, and we talked a little bit about Amazon and Whole Foods, the one sector in the retail universe that people still think is immune to the threat of e-commerce has been the grocery anchored strip, right? Because it's hard to ship a cantaloupe, and as Dory Siegel always said, you can't get a haircut online. The salons might be safe for the time being, but the grocery business is going to be hugely disrupted. Food retailing in the U.S. is a $700 billion industry. It's $120 billion in Canada. And if you think it's not going to be disrupted, think again. And to Michael's earlier point about their focus on the major markets, Oxford's focus, earlier this year, RioCan announced they're selling 100 malls. All of those malls are in secondary and tertiary locations. They're going to focus on the 6 major markets in Canada. And, we've been saying in retail for a long time, disruption is impacting everyone, but not all real estate is created equal. Not all retailers are created equal. And winners and losers are definitely emerging. If you own an enclosed community mall in Peterborough that's kind of mid-market, fashion-oriented, you are dead. And the gap between the good and bad.
That's a big term.
In fairness, it's like you're dead if you're that. Like, unless you decide actively that you got to be something different, if you stay on that format and you're waiting for the world to, come back. That's not a really good strategy. But it's still.
I think those types of malls will require the type of ownership that can recreate them, rethink them, plug them into the surrounding community a bit better, increase the experiential component of it. But if you're just a passive retail owner who's not really up to speed on all that stuff, and you're buying a secondary mall that hasn't really evolved over the last 10 or 15 years, good luck with that.
Right.
Yeah,
the-
I'd say there's a theme in what you said about passive. And so a lot of learnings that I think we have as a service provider to our customers is the innovations from our retail group, who have always understood that it's about surprise and delight and please the people that come to the asset. And as I started saying at the beginning of this session, like hospitality's known that for, since Izzy Sharp built his first hotel on Jarvis in 1961. It's all about the people inside. And what's happening here, and it's going to increase, is we're going to move from the mindset of real estate is an asset class, and you can play that, it's just owning concrete, to it's a business. And lots of people have been saying this for a long time, but increasingly, the power is to the consumer, and they are going to migrate to people and platforms that treat them like a customer. And not everybody in this industry has the capacity to operate as if they understand what the customer experience is all about.
So in talking about that placemaking, I just want to shift gears a little bit. I'd say probably in the last few months anyway, we've probably seen the most climate as well as personal security events that have happened. So think natural disasters, potential and actual terror attacks, and that sort of thing. So as you're going through that placemaking, do you think there's going to be an impact on how you actually build that real estate going forward?
We're getting the 5-minute hook there, so I'll be super brief. I don't know if I would respond to that in any differently than what we already do, which is we build assets and we look at those that we manage in terms of resiliency. We've had enough events, whether it's the power outage that was in this region and the whole Northeast that lasted for 4 or 5 days, and multi-day riots or floods in Calgary or fires in Alberta, that from a security and emergency preparedness standpoint, I think us as an operator understands what we're supposed to do. Where I think we have some catching up to do is cybersecurity, and as George's ideas infiltrate more of our lives in this industry, like we have a whole new issue that I bet you there's very few people in this room that have a colleague in their office that's responsible for cybersecurity in their buildings. You better be on that if you're not. So that's how I would respond to that.
One real quick one, I know we've got time, is I think your climate issue is a very important issue. And we are so lucky here, and you look around the world and you see the events that have happened. And you go, what does that mean for Canada? And Doug Saunders has a book that's just out called Maximum Canada. And I think there's some opportunity when you start thinking about Canada in a much bigger way. 100 million people. The world's climate is a real problem. We have the second largest land area of any planet in the world. We have 20% of the world's fresh water, and we account for 0.5% of the world's population. We're talking about, should we grow by 50 or 60,000 units? We've got places in the world that are adding 2 million people cities and setting grand ambition. So I think in the backdrop here, this might be a really good time to say, like, what is Canada? And what is our ambition in the world going forward. And I think these events are here to stay.
Okay, well, great. So before we get the hook from Richard and friends, I just want to thank you all for taking the time and joining us today for the panel and sharing your insights. And with that, I will turn it over to Richard, who will close us out.
Yes, indeed. I want to extend my thank you to the full panel and to you, Nadia, and of course PwC and the whole team. What an incredible report to have it go 39 years, 11 in Canada. It is, as always, evidenced by the number of people here today. An amazing tool, as Derek had mentioned at the beginning. And it continues to be so. So thank you, PwC, for your amazing work. I also want to thank our sponsors, our event sponsor in particular, Quadrangle, stepping up this year. This was fantastic. We had 24 other sponsors. I think they're coming up on the screen. but they're across all these tables, incredible support for us to allow us to do this and other things every single year. I'm not going to say anything more just to allow you to get into your day, but I just want to thank everybody for showing up on a Friday morning early. It's starting to get chilly, so all the more adventurous for you to do this. Appreciate it. You'll see us again next year. Lots of things coming up on your table are 2 important events that we hope you particularly take note of. Thank you.